Emmanuel Daniel, welcome to the show. Thank you so much for being on. It's an honor to have you here. Today, we're going to talk about the great transition. You have a book, the personalization of finance is here. Talk to us. What does that mean?
Sidrit, great to be on your show. Great to be able to address your audience on this book that I've written and the ideas that I've put together. Essentially, what I'm saying in my book is that finance is going to be increasingly more personalized than it ever was. That's the cover of the book, and there's a piece of ice cube on the cover. So I use the story of ice to describe what personalization will mean going into the future. A lot of bankers think that personalization means packaging their products, their mortgage products, putting it into a ribbon-bound gift package and giving it to the customer and making the customer feel like that particular mortgage was meant specifically for that customer. And it couldn't be further from the truth or further from the idea that I have in mind in terms of what I mean by personalization. That's how bankers think. Bankers actually think that what customers are asking for or need or want is a mortgage. But what customers really want is a home. The mortgage is a means of getting what they really wanted. So no matter how a banker packages his mortgage, it is still a means to an end. It's not a product in itself. It's not like going out and buying a Maserati or a Louis Vuitton bag, which is an end to itself. Now, what I'm saying in my book is that we are now coming to an era where, because of technology, because of platforms, because of the control that individuals have over their transactions, whether it's a payment transaction or whether how they borrow money from another individual or from an institution, the individual is gaining increasingly more control over how and who he wants to transact with. And so I used the analogy of the ice cube to say, just remember there was a time when ice cube used to be sawn out of the lakes out of Michigan or Boston, put on horse-drawn carriages, and then taken out to faraway places, whether it's New York or Havana in Cuba. And imagine the amount of wastage, the amount of uncertainty that's involved in making that ice cube available to the end user. And that was the trade in the 1750s. And, I say in my book, that there were people who dominated the trade at that time. And then the whole ice cube industry evolved. Today, if you go to some of these old towns, you'll still see the warehouses that the ice merchants used to use, which is they either collect or harvest the ice and then distribute that. And finance is very much like that today. The money that is in your pocket would have swirled around the world twice, gone through inflation, bank charges, uncertainties, risk, and so on, before it reaches you. And that's how uncertain the whole idea of finance is. So when I say personalization, it means that you and I can transact with each other when we want, how we want, to the extent that we want. You can lend me money for my mortgage based on a profile that is out there about me. How trustworthy am I? Who am I? And all that that you can get from a multiplicity of sources, and which is much more accurate in terms of how it describes me, because the data that exists all around us is rich today. It's just a matter of how you capture the data and make that available. Now, everything I'm saying right now might sound a little, a little bit off the head, but
no, it makes sense to me. Listen, I'm a loan officer. I'm a mortgage loan officer myself, and it makes total sense. You're not in the business of selling a mortgage. You're out there helping people realize their dream of home ownership, of buying a home. And if you do not listen and understand what they want, personalized to what they need, you're completely like out of touch with your clients. And I think, I mean, we have been moving in this position of personalized finance, but I think what you're saying is we're going to get into like a hyper mode of that.
Yeah. And we are halfway there already. Now, you would have heard, and your audience would have heard of P2P lending or peer-to-peer lending, where there are today platforms that brings borrowers and lenders and put them in touch with each other. There's billions of dollars of lending that's already taken place in that on those platforms, and they don't involve a financial institution. The platform doesn't take the loan onto its own balance sheet. It's really matching borrowers and lenders. But then we can go even further, where you don't even need a platform in the future. So everything that and not only do we not need a platform, but the information that the borrower and the lender can have on each other is so rich and it's so diverse and it's so highly networked with the communities that they belong to, and so on, and even information on the asset. Because today, when we say mortgage, what we mean is, a 7 to 30-year loan against a fixed asset. And the Gen Ys, the Gen Zs, they don't think of fixed assets in the way that the old people think. They don't think of a house as something that you're going to own for the rest of your life. The whole idea of assets itself is becoming ephemeral, meaning that why can't I own an asset when I want to? Wait a minute, is that a lease? Why? Yeah, well, if it's a lease, even the idea of a lease, how can we, with more information, make it more dynamic? And can I own an asset together with other people? Wait, is that timeshare? Well, it is, but because of the amount of information that is available, it's more than a timeshare. So we are coming into a world where some of these things that look juvenile even today, because they are rudimentary, they are pilot versions of the universe that we are getting into in the network world. As we get there, it's the demand side that will determine it. It's not the financial institutions that we know today trying to change the product for the customer. It's not. It's the you and I, because we have tokens in our hands, because we are networked with each other, because we are plugged into a whole richness of data about each other. We're able to interact with each other a lot better and a lot more precise about exactly what it is that we want to achieve with the assets that we have. So I'm saying everything. I'm saying how we interact, the nature of the asset, where the loan exists, in whose balance sheet, and the dynamic nature of the interaction with each other. So if you take a peer-to-peer platform, it is still the early days of that development. As we get more data and the data becomes richer and the data is validated between the parties without an intermediary involved, you find that the whole idea of lending starts to change. Now I am confident that this is where we are going, not because I'm dreaming this up. That reality already exists today. In order for us to imagine the totality of that ecosystem that we are getting into, it also includes the idea of money and what is money. Today it's a fiat or a fictitious currency created and owned by the state, and in the future it will be every bank can generate its own stable coin, which is not just money, but a token with which you interact on the network. So I'm saying many things. So we got to.
I got you. And before we move into crypto, I mean, mortgages are highly regulated by federal regulation, as you're aware, especially if you're buying a primary residence. There's truth in lending, debt to income ratios that you have to meet. How much do you think federal regulations would impact this personalization of finance, or would it have any impact of like slowing down this type of growth that we are seeing? I mean, the P2P lending, which is amazing. I don't think it can be done yet on a primary residence because there's certain disclosures you have to do. Maybe you are exempt because you're probably doing only one transaction a year. You're not like a lender of like, you know, doing 500 transactions. But just your thought, what would, you know, and you can talk about crypto too. What would regulations or regulating this environment mean for the personalization of finance?
Right. It's a brilliant question because it helps us focus where exactly we are in that transition that's taking place. Regulators are trying to even figure out where in the process they should play. On the one hand, they don't want to stand in the way of innovation as it evolves. On the other hand, yes, they need to protect the consumer. They have to protect society as a whole, and so on. You know, and there are a variety of regulators involved. There's the OCC, there's the FDIC, you know, there's the SEC. So each of them are like trying to regulate different parts of the elephant. You know, like a blind man, you know, trying to figure out what is an elephant, and then you know you touch the tail and you think it's a long, thin thing. You know, so the OCC is you know, very concerned about the institutions that are involved. And the deposits that are created, you know, the FDIC systemic risk, and you know, and the SEC, the token that is utilized in terms of you know, to make the transaction, you know, whether it's a token, whether it's a security, you know, that kind of thing. So now, is regulation standing in the way of facilitating the process? The regulation today is chasing the innovations as it takes place. You know, so they've not sort of stood in the way. Some innovation have taken place because regulation hasn't reached it yet. So like peer-to-peer lending, for example, it first took off without any regulation. And then eventually the regulators got in and said, if what you're dealing with is a mortgage, well, we've got a law for that, you know, and you'll be regulated in the same way that banks would be. But what if you know, what a person is looking for is not a mortgage. You know, it's a form of a lease or a dynamic lease where he gets to use an asset when he needs to, and then you know, and then he co-owns that asset with several other people. Regulators haven't got there yet. You know, so it's for the entrepreneur, the innovator, to design the product and then rename it. So that it's not called mortgage, and then it stands outside regulation, and then regulation will eventually catch up and say, okay, look, because there are too many players in this field, it creates a systemic risk. We're going to regulate it like a mortgage. Okay, yep. So regulators are in that way, you know, chasing the innovation as it evolves. The fact that they have captured some of the innovation and called it mortgage, for example, and then there are existing regulation on mortgage, will start to look different as technology puts more data into the process. You know, so I say this in my book, which is the peer-to-peer revolution was only in its early days, and in its early days, just because it's a platform and it brings the borrower and the lender in touch with each other, hasn't completed the process yet. Because in future, both the lender and the borrower is going to have incredibly more information on each other. The lender is going to say, how many thousand other potential borrowers are there who has the same profile as this borrower? You know, and if I take on the asset as collateral, how many other you know, lenders can I hive this off? And can I repackage the asset into different elements based on the borrower's needs and lifetime? meaning that, in the first 3 years, you'll look different, the next 7 years, you'll look different, and so on. What is it that we need to achieve? Now, much of this information today is either not available or it's all over the place, it's disparate. And processing it is going to be very difficult. With artificial intelligence, with open source platforms, there's a lot more technology that's going to make that easily transactable. Now, this process that I'm talking about is not a 5-year process. It's not a 20-year process. It might be a 30 to 50-year process. But just because we're able to imagine it, then we know where technology is taking finance and where technology is taking society as a whole eventually. Now, so the book that I've written is not necessarily for the dreamers, but for the people who actually run this business today. And as the innovations come in place, and then they look at their traditional mortgage business and it's starting to look different because customers are no longer asking for a 30-year loan, and customers are asking for a 7-year dynamic loan. Can I share this with another 3 other customers and stuff like that? So as this happens, it gives us a sense of direction of where it's taking us, and of course, a number of other things need to play together. So for example, I'm saying to the platform players, the technology guys, that the days of the platform are over. The days that banks need to set up a digital bank and then bring everybody together and still be the intermediary, those days are over. Why? Because the individual is taking charge of his own transactions more and more today. And sometimes the individual might do his traditional banking using the traditional bank's digital banking platform, but he will have an alternative reality which has to do with decentralized finance, for example. And there are two different universes today. But over time, these two will start to coagulate, they will converge. And the traditional banker will see this on his balance sheet. Why aren't customers coming to me? And why are they going to this other platform, which is not as secure as I am? That sort of thing. And this is already happening. You actually see that mortgages are not just hived off, repackaged and sold off as different securities, but the origination of mortgages also coming from different sources and different platforms. It's just like the days of the Model T car when it was introduced in 1901. The car was heavy, it was slow, it was noisy, and all the laws that you could think about were stacked up against the automobile and not on the horse-drawn carriage, because the automobile was a nuisance on public roads at that time, But over time, the automobile, and in fact, they used to have a red flag rule where an automobile needed to inform a horse-drawn carriage that they're coming from behind, because otherwise you scare the horses and so on. Just imagine that's what it was. And then as we went on, and there are photographs of New York City where in 1901 there was a single car and then everyone else was a horse-drawn carriage. And then 1920, the horse-drawn carriage was a minority and everyone else was in a
That's
car.
insane.
Yeah,
they wanted to see how they could make the horses faster, right?
and they were thinking, well, we got to get this right. The horse has to be faster, right? If you put 2 horses, it's faster than one. Now, and then what happened was cars just became faster, quieter, lighter, didn't damage the roads, and so on. So, and the laws that were put in place evaporated. They were unnecessary because they didn't deal with the institution or the vehicle as it was evolved. So we need to think of finance in that way, that we're in the early days where the technology may sound cumbersome and may sound very restricted, but we are entering a networked world where the way in which people interact with each other, never mind get a loan or a mortgage, is going to be very different from the transactional world that we live in today.
I think the status quo, banks, they don't want this to change, obviously, for many reasons, and that's why they didn't like the crypto space because of the way it operates and the decentralization. Sounds like you've been listening to what people have been saying. The technology is there. I mean, look at Chat GPT and all the other AIs that's coming up. And that's where we're eventually heading. It's also a matter of adoption, right? Mass adoption. Where now, let's say with, I mean, this is something different, but we're currently 5% of the cars in the US are electric. But now that people are seeing adoption in that market, we're expecting what? 30% of the market in the next 6 to 8 years. And same thing with finance. Once people see this, me and you know the peer-to-peer lending, we may have even done some, but majority of the people don't know, right? And it's because the status quo industry, they don't want things to change, right? I mean, they lobby for things to remain the same, and it's people like you that are a voice out there, coming out with a book and educating others, and I appreciate that.
Yeah.
Yeah,
In fact,
I mean,
I'll say this to you, Sidrit, which is that the biggest pushback, on my book, especially because I shared this with executives from different companies, I was surprised that the biggest pushback came from the technology companies themselves, from people at Google, for example, because
I'm not surprised.
because Google in a very short time has been successful in creating this platform, industry, which they dominate, that they don't want to see that change. They want to be the intermediary for all transactions, and they cannot allow the world where the individual takes charge of his own transactions, and it's actually the suspects are the very institutions that we thought promote innovations, and the big thing about the US is that it's big business that pushes back on innovation. They want to maximize the profits that they can with the technology or the platform that they have mastered, and they will hold on to it for as long as they can, until the capital gets deployed and the profits are squeezed out of it before they allow the new innovation to come into place. So the pushback that I've got from my book, like for example, the platform players like Google and even Facebook, they were saying that what's wrong with our existing system, and on the payments front, they are very happy with the credit card-based transaction platforms that exist. And I was saying to them that go to Africa, where payment transactions are no longer through credit cards, because payments has been reduced to a transaction between two individuals. It's basically a transfer of information. Wow. In countries in Africa where payments means a transaction from my phone to your phone, there's no bank in the middle, and the money exists in your little SIM card, and people in the US cannot fathom that. Because we are all used to the credit card, not realizing how antiquated the credit card industry is. There are 5 or 6 players at the back end, all profiting from each credit card transactions that exist. Course. And it takes 3 days to do settlement. When because it's information today, it can be instantaneous. And if I can send you information for free, I can send you a payment for free. It's just as simple as that. So.
Listen, we're still writing checks, so
and we're still writing checks, and an innovation of the ACH is a big deal. It's like the ACH should not even exist, so that's where we are, But the interesting thing about the US is that it doesn't change until it does, and then when it does, that transition then dominates the world. Okay, so and it's been that same formula for all kinds of innovations taking place. So there's something that we need to understand about the US itself. It's a very capital intensive, incumbent centric business model. And that's where the resistance to change comes from sometimes. I mean, in this case, in fact, in all cases of innovation.
100%, 100%. Where can we find your book, Emmanuel?
Well, I mean, if you go to my name, emmanueldaniel.com, that's my blog page. There's the whole page dedicated to the book. That's the easiest place to find it. And I've been adding content even after having published the book. So I look at different aspects of innovations in finance, and then I realize that some of the themes that bankers like to think that they are pushing for, that they're facilitating, are not even true. So people in the banking industry like to talk about innovation in finance as facilitating financial inclusion, for example. They like to say that because technology is cheaper, we as banks can now include people who are previously excluded from finance before, when actually that model doesn't exist at all. And the reason is in the platform economy, the reasons the platform funded by venture capitalists is to onboard as many potential users onto the platform and then to monetize them. So
100%.
To get people who are unbanked or underbanked on platforms is to monetize them and to make them subservient to the financial system as we know it to be. I mean, as it exists today. So I am able to call the bluff on existing interpretations of innovations because you see it for what it is and you know where it's heading. And you know what needs to crumble in order for the new reality to come into place. Like for example, financial inclusion. People don't want a bank account. They don't need a bank account. Nobody ever needed a bank account. They just needed a platform on which they could interact with other people. And when you think about something like stable coins, for example, now there's a whole discussion on what stable coins are and how they should be run, how the algorithms should be transparent and so on. But we are coming to an age, and I'm saying this to bankers, okay, that they should even give up the most treasured banking product that they cannot imagine a bank being without. And what is that product? The bank deposit. The good old bank deposit. Think about this. You and I, when we put money into the bank today as a bank deposit, we get almost nothing out of it. The interest rates on bank deposits are like 0.5 or 1% if they're generous. It's the most useless of product for the end user. And what do banks do with their excess deposits? They go out and trade with it, and they make billions more money out of that, and it shows up on their balance sheet, on another part of the balance sheet, while telling customers that, how expensive your bank deposit is, and so on. Now, and we've now reached an age, and not so much in the US, but in many other countries, what people like to have is a digital wallet. Exactly. And with a digital wallet, they're able to interact with other elements in their own society. You can use it for your cab fare. You can use it to go out to restaurants. You pay each other, and your whole livelihood takes place in your digital wallet. And you don't have to be a bank to have a digital wallet. And you take it to another level, a digital wallet, which becomes a token that can be used for, network transactions. That's a stable coin. Then I'm telling the banks that, can you imagine a world where every bank in the world issues its own stable coin? Stable coin. Right? Yeah. And then interacts with other banks' stable coins. And it's a question of which stable coins are respected in the marketplace, accepted, and the valuations are holding because they are being used for various transactions and so on. So the integrity of the bank is tested in the network. Okay. Now bankers cannot imagine this, and in order to bring home the point on that, I say to them, remember Kodak? They invented digital film in 1995 together with a few other players, and guess what? They were the very ones that didn't trust their own invention, and they continued to sell the 35 film right in the 2000s. And 2001, Sony came up with its camera. What do they call it? Cyberpod. I can't remember the name now. But Sony came up with this camera in 2001, and 2007 was the iPhone. And all through that time, Kodak was still selling its wonderful 35 yellow box that you saw in every advertisement or on a tourist site, right? And 2010, Kodak went into bankruptcy. Because its holding cost of its business model was way offline, and people had moved on to digital by that time. So that's the kind of innovation that we're going to see in finance, and it's well on its way. That process is working its way right now.
100%, 100%. We are gonna have to continue this conversation on another time, and I hope that a lot of things that you've written in your book and we spoke a little today about become true, and we can see how we all advance for the better in finance and in life. For those of you listening, make sure you go and check out The Great Transition, emmanueldaniel.com, correct? And then I'm sure it's on Amazon and other platforms as well. You do have another book coming up, The Winning Civilization. So hopefully I'm excited about that one too. But I appreciate you. You've really sparked my curiosity on so many levels, and I hope it has done the same for our listeners. Thank you so much, Emmanuel.
Thank you very much for the privilege. And, and yes, this is a continuing conversation. In fact, I end my books by saying that when finance is personalized, all of society is personalized. And it has major repercussions in terms of how, society itself will hold together. So I hope to have that conversation with you later.
We'll do it again. Thank you so much.
Take care.